You spend hours studying charts and memorizing patterns, yet your account balance continues to drop. It feels as if the market is actively hunting your stop losses. This frustration stems from a hidden reality. Every trade you execute is an entry into a high-stakes, asymmetric war. You are facing off against smart money. These are institutional funds moving hundreds of crores at a time, backed by elite teams and algorithmic software. Your losses aren't necessarily a failure of chart reading. They are the result of playing a solo game against an organized global army. This chart highlights the massive resource gap. On one side is the retail trader. On the other, institutional desks with 500 crore positions. Challenging that momentum leads to failure. When giants move, smaller positions are swallowed by institutional orders. To survive, you have to stop trying to beat the market and start tracking the footprints of those who control it. Survival requires a pragmatic shift in mindset. Find where the giants are stepping and walk exactly where they walk. A common narrative in trading circles claims that market manipulation has made foundational price action obsolete. However, market manipulation and institutional traps existed 30 years ago. Traders were profitable using price action then, and the core mechanics of how price moves haven't changed. The smart money concept, or SMC, is actually a refined extension of price action. It didn't replace the old rules, it evolved directly from them to better identify where big players are active. Abandoning price action for SMC is like removing a building's foundation just to install a better roof. The two systems rely entirely on each other. If price action still functions, why should a retail trader bother learning the complexities of SMC? Consider this chart. A steady uptrend followed by a sudden, sharp drop. Price action alone presents a dilemma. Is this drop a minor correction, a buying opportunity, or is it the start of a total trend reversal? SMC acts as a high-resolution filter. It identifies institutional footprints in that dip, confirming it as a temporary liquidity trap rather than a reversal. It provides a definitive answer, where basic charts only offer a guess. Layering SMC over your analysis removes the technical ambiguity that leads to costly errors at critical turning points. The biggest mistake a beginner can make is rushing into SMC without first mastering the basics of price action. Without a clear understanding of the foundation, advanced concepts become confusing and difficult to apply. With a structured approach, a dedicated student can map out both systems and reach technical proficiency within 5 to 6 months. But remember, knowing how to read the chart is not the same as being profitable in a live market. Technical analysis only provides the map. It places you on the right side of the trend, but it cannot handle the psychological pressure of the trade for you. The ultimate barrier to profit is your own response to pressure, the panic and greed that surface when your capital is at risk. Technical confusion is the primary trigger for emotional trading. By using SMC to reconcile price action, you eliminate the second guessing that leads to panic, leaving your mind clear to simply execute your pre-planned discipline. You reach a state of synchronization, navigating the market by utilizing the momentum of the dominant force, rather than fighting against it. When you use price action to understand the terrain and SMC to track the giants, you stop fighting a war you can't win and finally begin trading in alignment with the smart money.